Bob, let us turn to the United States economy. We've got to get ready, and I think it's 12 or 14 days, 12 days for a Fed meeting. But just the view on interest rates. I think there's so much noise, Turkey this, India that. We've forgotten about where's the 10-year yield. Can you own bonds today? Can you own them for price higher, yield lower?
I don't think you can. I think the Fed has made it clear that there's more room to the upside on the Fed funds rate, and we think they're headed another 100 basis points. They're also going to ramp up the balance sheet runoff. You've got the ECB cutting its balance sheet expansion. So all of those things have created a lot of buying in the long end of the market, and they're going to dissipate as we roll into next year. So I wouldn't own 10-year treasuries anywhere below 3.25%.
Well, there you go. Thank you for that single point estimate. We greatly appreciate it. But Bob, what I find fascinating here is we're grinding up, but inflation's coming up with it. Do you see any expansion of the inflation-adjusted yield, or do we just have stasis as we ramp up?
Well, I think that's got to be some of the frustration of the Fed and other central banks where they've been raising rates. They've been trying to restore some real yield to the market. But as you point out, all they've really done is compensate for the increase in inflationary pressures. I think once they exit the support of the markets and quantitative ease converts to quantitative tightening, you'll see the long end of the market start to price in more realistic inflation expectations.
When would that be, Bob?
We should hit quantitative tightening sometime in October, November. And I think once the ECB backs out of the market at the start of next year, first, second quarter, we ought to see the full impact of a repricing of government bonds.
Okay, and that would actually also bring some unintended consequences for emerging markets, or did the emerging market repricing continue first?
Well, I think the emerging markets are the one out there that have gone through the painful repricing. It was a very crowded trade at the start of the year. It made a lot of sense. There was going to be a lot of economic activity out of the U.S. with tax reform and the spending bill. And the emerging markets were going to be the supplier of goods and services to a lot of that. And of course, the tariffs have changed that.
But Bob, if China is the secret to what happens with the markets left, right? What is being priced in on how much extra stimulus China needs to do to actually keep the economy as where it is now?
I think the markets are starting to become pretty sanguine on China and starting to accept that China is doing the kinds of things investors want to see. Rather than attempt to escalate the tariff and potentially create a trade war, they're trying to compensate for it by reducing the pace of deleveraging, by injecting liquidity into the system, by cutting borrowing rates.
Bob, then cutting rates is a spread market as well. For the pro investor right now, where's a sophisticated spread trade? Where's it? There's many spreads folks out the yield curve. Where's the pro one right now? Where's the opportunity?
I'll tell you, European high yield is sure looking pretty good right now. It generally trades at a credit spread 100 basis points or so wider than the U.S. high yield market. Or 100 basis points through the U.S. high yield market. And currently, it's trading wider than the U.S. high yield market. Now, there's some reasons for it. The U.S. has been pretty strong. You're seeing that in corporate earnings. And there have been concerns about Brexit and Italy and Europe. But corporates in Europe look very strong to us. They're benefiting from a weaker currency. Earnings are looking good. It's a shorter duration, higher quality, high yield market than the U.S. high yield market. So the opportunity is there for us.
What is the issuance question? What are corporations actually doing right now? I've really lost track of the story, to be honest. What is the action of CFOs right now?
Well, in the U.S., the action had been to ramp up issuance. They have a lot of financial flexibility. They were looking to buy back shares, raise dividends, buy each other through acquisitions in a lot of cases. So we were on pace for record issuance this year. That seems to have cooled off a bit as companies have a lot of free cash flow at their disposal, a lot of it thanks to the benefits of tax reform.
Well, with the benefits of tax reform, that's going to go away. What happens when those benefits taper away in 2019?
Well, the benefits don't entirely taper away, right? Because they're enjoying a 14% reduction in tax rates for the foreseeable future, I guess, until tax law changes again. And I think that's one of the struggles in corporate America, trying to figure out what to do with that. And they've got a lot of choices. So in the meantime, we don't mind extending credit to them because they look very strong and earnings look great.
Bob, what makes you worry about in the currency markets? I mean, we saw a lot of volatility. Is this going to continue into 2019?
I don't think so. I think there's been a lot of optimism and euphoria built into the dollar. And we're approaching a point where we should see the growth and the interest rate divergence start to cool off a bit. We talked earlier that the Fed may be pausing raising rates 9 months from now, just as the ECB begins to raise rates. And that will start to be telegraphed to the market over the next quarter.
Okay, so what does that mean in terms of currencies that you like?
Well, we think it's time to start scaling out of the dollar.
Okay.
And the currency market that's been hit the most is the emerging markets, and for a lot of good reasons. But it feels to us a lot of the crossover investors into that market, a lot of the tourists into that market have been washed out of the market right now. And we've seen some of the traditional structural players also reduce their exposure. So there is some attraction to the high yielding currencies. Maybe it's a bit early, but there are some other currencies like the Mexican peso, which look stable to us, particularly if NAFTA proceeds.
But at the same time, if China's getting worse and they have to stimulate more, and if China focuses on stimulating internally, then that is, a lot of the money that they in the past have helped emerging markets with is gone. So does that bring another correction, a fresh correction on emerging markets?
Well, I think China has a more balanced economy than everyone gives them credit for. So they're not purely a manufacturing and export-oriented economy where if they turn inward, then that has an impact more broadly on trade. I think what you'll probably see is China remain pretty healthy, try and target 6 to 6.5% GDP growth, and the other emerging markets will participate in that.